Hi, this is John Holston, and in this presentation, I'm going to be talking about sensitivity analysis in a financial context. This is just a quick overview slide to show what all is going to be talked about in this presentation. So to get right into it, I'm going to start by talking about the goals of financial management. So the goal of financial management is to improve business operations and increase efficiency. Within this goal, financial management exists to make more efficient use of financial resources, including capital, maximize the possible profit the company can produce, increase shareholder wealth by improving business efficiency and performance, and understanding and managing financial risk. It has a variety of means to achieve these broad goals, but these are the primary goals of financial management. Next, we're going to talk about the functions of financial management. Financial management is a key factor in making good business decisions and understanding a company's financial position. According to principles of finance, financial management plays a role in assessing how capital is obtained, such as through acquiring or issuing new debt via loans or issuing bonds, or through equity, such as with issuing common stock for a publicly listed company. It also drives decisions on resource allocation in the context of the company's risk environment. Finally, financial management provides for future projections and forecasting of financial needs, using present information such as what is available from financial statements in conjunction with risk assessment tools to model how a company might fare at a time in the future or in a given scenario. Next, I'm going to talk about sensitivity analysis. The sensitivity analysis is one tool available to financial managers and is used to look at how sensitive a project is to various risks. To do this, it examines and ranks the risks a company is exposed to when considering a position or a decision, so that those can be prioritized according to how sensitive the business is to them. This information helps to guide the decision-making process of business leadership by giving context on which risks will be of greatest concern and how significantly they might affect outcomes. This is also very useful in preparing for risk mitigation strategies. Going on to the next slide, looking at some of the steps for conducting sensitivity analysis, I'm going to start with the qualitative steps. Now, all of the steps involve some mix of qualitative and quantitative aspects, but for this slide, I'm going to be specifically looking at the qualitative aspects. So conducting a sensitivity analysis involves a number of those qualitative steps. First, key factors and influences need to be identified, which can be driven by quantitative data, but can also have qualitative factors. For example, what trends are going on in the market that might impact a business decision? What do potential or existing customers think of the company or the proposed product? Are there other social or cultural factors that might play a role in how the business decision is perceived by the public? Next, we prioritize our variables based on the level of impact we think that they would have on the business and what level of uncertainty we should consider. If we have historical data, we can use a quantitative approach to determine the potential monetary cost of each variable. However, this can also be qualitative in nature, especially if we do not have reliable historical data to go on. Additionally, if those variables' prioritization can influence how other variables are regarded, this can also be considered. After that, the next qualitative step would be engaging with shareholders. Since one of the goals of financial management is aligning the interests of the business with that of the shareholders, i.e., maximizing profitability and shareholder returns, it is important to get their inputs and sometimes buy-in when assessing risks for decisions. How the business perceives and prioritizes a risk may differ from shareholder perceptions. Finally, we want to consider the possible implications of different outcomes of a given event. Whether it aligns with the base case, best case, or worst case for a scenario, the business will need to be prepared to adjust to that new context and new environment. All of this financial insight will then need to be translated to better inform the business leaders so they can make more efficient use of resources, maximize profitability, and manage/mitigate financial risk. Next, we're going to look at quantitative steps. So most of the steps, again, are in conducting a sensitivity analysis will have both a qualitative and quantitative component, and we're now going to look at some of the quantitative considerations. First, when identifying key factors and influences, quantitative considerations might include how sales volume and price relate, or sources of inefficiency that could be targeted. Next, we would want to describe the context for the scenario quantitatively. What are the values that we are going to use in terms of time and money, such as current or expected sales figures, operating or non-operating costs, and how capital structure is split between debt and equity? Third, we would want to determine what quantitative values we need to consider when prioritizing variables. Notably here is what range we could expect the variable to possibly change in and how significant that resulting impact would be. For example, if the manufacturing cost of a new product could increase the cost of goods sold anywhere from 10 to 80%, that might increase the priority of that variable than if it could only vary from 10 to 20%. Fourth, we'd want to explore scenarios. Here, a tornado graph would be an excellent tool to depict the sensitivity and potential impact of different variables with scenarios. Next, we would want to consider how our modeled scenarios would mesh with shareholder priorities and perspectives, and how substantially those scenario outcomes might impact business profitability, capital structure, etc. And finally, we would want to translate our quantitative insights to inform business leaders in a way that can support decision making. Next, we're going to look at some internal methods for determining risk for capital budget analysis. Assessing risk is a critical function for financial management, and there are a variety of ways to approach it internal to the business. Sensitivity analysis is one, where, as shown in previous slides, risk can be ranked and prioritized, and base case, best case, and worst case scenarios can be considered for possible decisions. As demonstrated by the Corporate Finance Institute, it is easily facilitated by using a tornado graph, where the relative sensitivity of each risk can be easily understood and compared, as shown on the slide. Expected monetary value, or EMV, according to Belinda Fremeau at Passion Project Management, is another such tool where the probabilities and resulting financial outcomes of different scenarios can be directly compared as financial values. Net present value, or NPV, is used to determine the present value of cash inflows and outflows over a period of time. According to the fundamental principles of finance, it aims to answer the question of if an investment will create value over time or not, using present values. Once calculated, if a scenario yields a negative NPV, then it means it will not generate more value than it costs. In other words, NPV needs to be positive or the decision will cost more than it returns. Internal rate of return, or IRR, is the financial return on funds that remain internally invested in a project. It works hand in hand with NPV since it is used to find the discount rate at which NPV will be zero. In other words, the rate of return at which invested funds will break even and neither generate a positive or negative return in present value. Finally, a Monte Carlo simulation is a statistical tool used to generate hypothetical data or simulate data given parameters and ranges of variance for variables. It is useful for assessing scenarios and potential outcomes if historical data is not available and or if present data is either too limited or not reliable enough to remove outliers and accurately represent the situation. Basically, it allows you to simulate significant amounts of data through modeling. Next, looking at external methods for determining risk. External to the business, risk can be determined by looking at the market or the relevant industry and analyzing where it is likely to go in the time period you're considering. What risks does it face? What could potentially happen that might shift the market/industry, and what are the likelihoods of those events happening? Economic forecasts would also be worth considering, especially if the performance of the economy writ large could impact your business's performance. If inflation or federal interest rates are expected to change, could that impact your returns? If GDP increases or decreases, how could that affect your company? Finally, getting a fresh set of eyes on the business can help to identify and assess risks in the business that might have been missed within internal methods. Consulting partners or suppliers can help with identifying and engaging risks, as can third-party auditors. This is my last slide. These are the sources of information for this presentation. Thank you for listening, and if you have any questions, please reach out to me via my AMU email or through the appropriate discussion channels for this course.